Matt Maurer wrote, David and fools, my question is this. Are buybacks counterproductive to the market at large when many companies are doing them? I often hear the 17 price-to-earnings ratio cited as an average, and when that average creeps above 17 to 19, pundits point to that indication saying it's an expensive market. Expensive market, Matt goes on to write, in turn becomes fodder for all of the top callers, the fearmongers. Seems like most repurchase plans are poorly executed, etc. Matt's note. Very understandable. Very good question. Let's be clear on this. Companies can buy back their stock. It happens all the time. Just like you can buy a stock or you can sell a stock, companies do that with their own stock. And a lot of companies sometimes fall in love with their own stock. They purchase their stock at the top. They make all the mistakes that you and I might make and do sometimes make as investors. A lot of companies are buying back shares merely to retire shares that they're going to be giving to their employees. And others do it as a matter of a more efficient use of capital. For example, if you are a slower growth, more mature company and you have a ton of cash because you're making a lot of cash flow, but you can't reinvest that in your own business at a good enough rate of return. Maybe your business just isn't growing that fast. Instead, you can buy back shares. And when you buy back shares, if you and I are shareholders and the company's buying back their shares, it's reducing the number of shares, right? So when the company reports earnings per share, all of a sudden, that goes up, right? Because there are fewer shares. And so the EPS or earnings per share of that company is higher. And that'll cause the stock usually to do better thanks to a good trading multiple off of that rising earnings per share. So companies are doing it. They could have paid dividends with that money. They could have reinvested in their business, but some companies just buy back shares. So overall, Matt, my view of this is it's a perfectly fair use of capital when done properly. The two key conditions we're looking for here are, number one, if companies are egregiously giving away lots of options and shares to employees, this is a way just to keep things under control by buying back shares in the open market. But number two, especially if it's a more mature company, as I just mentioned, it's an okay way to use capital, assuming that the management team is making good decisions on when to buy and sell stock. You and I can see what this kind of activity looks like. For example, I just saw the earnings report for Texas Roadhouse, a Motley Fool Stock Advisor pick this week, and the company listed the number of shares it had bought in the market over the last quarter and paid, I did the math, about $35, about 35.5 for those shares. The stock, as I do the podcast today, is about 41. So I guess you and I would say that was smart, right? The company bought low and the share price is higher today. But of course, that's a short-term measure. But I want you to know that I don't use buybacks overall as a big indicator of where the market's headed. And there's no magic price-to-earnings ratio. I'm foreshadowing a later mailbag item we'll be speaking to. But there's no magic price-to-earnings ratio that I'm looking for to see when companies do the most kinds of buybacks. I do think it could be interesting if you have an overall market view of the number of buybacks and you have a historical appreciation for that. I think that can be fruitful. Not part of my own approach, but I think it's legit. Thanks for a good question.
As always, people on this program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. Learn more about rule breaker investing at rbi.fool.com.